for the better part of almost 20 years, you operated in a zero interest rate environment. As a private equity professional, growing up in that environment is very different than what it is today. So the ability to navigate through that has been challenging.
Anthony is very calm, cool, and collected. I was on the short side of the market, and I was in commodity trading with my commodity hedge fund at the time. And who here has watched The Big Short? Anybody? Anthony is saying this so calm, like the calmest I've ever heard anybody that I've interviewed during that time frame. But it was like a slow nuclear explosion wiping out centuries of companies overnight, and they were literally there to pick up the pieces and restructure, which is pretty amazing. So let's fast forward. So I know that you guys focus on private equity, and we're in the private credit space. And private credit has gone from what is that to trillions under management. We didn't even call it private credit when it was eight and a half years ago when we started. We were raising debt to provide balance sheet financing for the lenders that we work with. And it was, I can't predict the future, but we thought there might be volatility, and we wanted to be in a market segment that would do really, really well coming into recession. Obviously, we couldn't have predicted COVID, and I would say that was not a real recession because it was a blip, hyper unemployment, and yes, our models did fantastic at that point. It was the best performance ever in history of the company. In the first 90 days when there was no stimulus money, I always talk about that. But as we're coming into a little bit of uncertainty, one of the things from a macroeconomic standpoint that we always should be watching is how not just the unemployment rate, but the job openings have been coming down as well. And it finally crossed the weekly numbers in this last report. And that is still sideways. It's been a very, very slow increase in unemployment and decrease in job openings. I mean, it feels like 2021 was yesterday when there was 12 million job openings, which was like the highest it had been ever, and lowest unemployment rate in like 50 years or 40 years or something like that. What are you seeing in terms of private credit, the macro economy, and like unemployment? I know that's a lot, but I think they're all kind of connected. One of the things I've talked about is potentially private credit could be a house of cards. You've got a firm like Apollo or KKR or Blackstone doing the equity on one deal and flipped on the other deal where they're doing the private credit. It's all kind of interconnected, and sure, these, the banking market has pulled back. So yes, when Mark Rowan at Apollo talks about that there is a place for private credit, it makes sense. But what's a worst case scenario? What could it turn out to be? Because there's a lot of interconnected parties, and they're all doing the same deals. And there's not that many deals, and there's literally trillions of dry powder chasing after a small segment. What are you seeing in the marketplace?
Sure. So our client base is predominantly private equity, also family office and sovereign wealth. And for us, they function very much like private equity. We do have some private credit clients. I have a few personally, and they've been fairly active over the last few years, looking at things that are a little bit off market, if you will. So unique structures, companies that perhaps aren't performing as great as they should, have a lot of debt that need to be refinanced. So we see a fair share of that. I think there's definitely a lot of pressure to put money to work. As JP said, over $1 trillion of dry powder. The ability to provide distributions over the last few years has been challenging for the macroeconomic reasons you've mentioned, whether it's unemployment, more recently the tariff situation, up until last week, more expensive financing. And those are things, think about it, right? For the better part of almost 20 years, you operated in a zero interest rate environment. As a private equity professional, growing up in that environment is very different than what it is today. So the ability to navigate through that has been challenging. And the conditions today weren't necessarily in the models when the investments were made 3, 4, 5, 6 years ago. So it's a confluence of things that are making it challenging today. I would tell you that private credit has been very aggressive to capitalize on the opportunity where historically the big banks would fill that need. And because of the challenging macroeconomic situations, they've been less inclined to put money to work on the financing side. Hence, private credit steps in. Different price point. I would argue probably more flexibility than most traditional banks. And that's been good on one hand. On the flip side, you mentioned, could be a house of cards. I think many of the credit agreements and situations that these funds are investing in provide flexibility on the part of the company to navigate through difficulties. So, in other words, if there are problems, many of the institutions are willing to navigate through that, extend, and not necessarily penalize the companies or take ownership. There's a lot more flexibility than, say, 20 years ago when that was the case. So I'm a big believer. I don't have that pessimistic of a view that things are going to turn upside down and there'll be a ton of troubled restructurings because of private credit. I think the conditions could be there, but despite all the more recent economic data, the impact of tariffs, it hasn't been as bad as everyone expected. So hopefully that'll continue to be the case. You're always up against the backdrop of any geopolitical issues that could turn everything upside down. But I think there's enough ingenuity on the part of most companies with things like technology to navigate through things that perhaps 10 years ago they couldn't. I think companies are a lot more innovative for the most part and have the ability to adapt on the fly and react quickly, whereas in years past, because of the advancement of technology, they didn't always have that ability. Then what happens is, even though you may have expensive financings or expensive debt, you have the ability to withstand that and get through it for a longer period of time than maybe you would in the past. So I'm not entirely worried, but we'll see. You never know what tomorrow will bring.